Well, thank you, Greg. It's so great to have you here at our GenZero Climate Summit. So the story about climate impact for GenZero actually begins with who we are. As a double bottom line investor, GenZero seeks to deliver positive climate impact alongside long-term sustainable financial returns. Financial returns, as we know it, is typically measured by IRRs or MOICs. But what about climate impact? What is climate impact? Is it measurable? And can investors set targets like how we would set IRR targets for our investments? Greg, what are your thoughts?
Well, gosh, we're going to see some slides through here, and I think we'll have a chance to talk about some of the details here. But before we get into that, I'd actually love to turn the question around to you for a second, which is, I think we deal with lots of people who want to talk about being able to measure financial returns and climate impact at the same time. But one of the things that I think we've all found so inspiring about working with GenZero is just why you decided this was so important for you as an organization to get both of these right. And I'd love to hear from you sort of what the motivation for that was.
Yeah, so we've heard $1.5 trillion have been poured into decarbonization solutions, clean technologies, green investments. But do we actually know whether all this money are actually helping to decarbonize towards this race to net zero? Do we really know whether our investments are actually reducing or removing carbon from the atmosphere? I think that's the fundamental question that we have. And given the limited capital that a lot of investors have, given limited time that we all have, I think we want to make sure that we are really channeling and deploying capital into the most effective solutions to help to solve the climate crisis. So, Greg, you are really the impact expert over here. Can you maybe just share with us what exactly is climate impact all about?
Yeah, sure. I think it's good to start off with a distinction. I think lots of folks really understand what carbon accounting is. We spend a lot of our lives talking about Scope 1, Scope 2, and Scope 3 emissions, phrases that we really couldn't use in polite company 5 years ago, and now really are a part of our daily language. And I think that the world has really moved to understanding with kind of pretty good clarity kind of what carbon accounting looks like. Climate impact measurement is something distinct from that, right? It goes beyond what your level footprint is and says what impact is your business or your investment actually having on the total amount of carbon that's in the atmosphere. That can be from carbon removed, carbon reduced, or carbon avoided, but it really is asking that question, why does the world look different because of the investment you've made than the world if you hadn't made that investment? And it comes back to the point that you led us here with, which is, look, we not only need a lot more capital going into climate. We heard the numbers before, and wherever you come out, it's not just moving from 1.5 trillion to 4.5 trillion. We need to motivate that increase, but we also need to allocate that capital effectively. And understanding climate impact is key to understanding how to drive the increase, and how to make sure the 4.5 trillion we do invest has the greatest impact it possibly can.
So where is the industry on this, Greg?
Well, so the industry is really still quite nascent, and I think that what's been super encouraging for me now, having been in the impact space for gosh, over 20 years, I think I'm officially old at this point, is just how much enthusiasm and progress there has been in thinking about climate impact measurement over the last really 2 to 3 years. And I think that enthusiasm has not yet translated to convergence on a set of how climate impact is measured, but it has translated into, and I think we heard the phrase a number of times earlier today, really transparency. Kind of transparency and real kind of credible authenticity around saying this is the impact that we're having. And we might not all agree on where climate impact is, and you can see from the sets of folks that are here, whether or not it's the standard setters from the folks at the greenhouse gas protocols, what you might get from the impact management project, IRIS Plus and the like, what you're getting from industry bodies like Project Frame, Mission Innovation, or the folks we heard from Breakthrough Energy yesterday, they're all trying to make progress in being able to understand what their impact is, but those impacts aren't necessarily the same. The way GenZero invests and the market solutions it's trying to provide are different than the ones that Breakthrough Energy is trying to provide. And so we all need to develop right now our own credible and transparent approach to being able to make progress. And I think that's where you guys come in.
Yeah, and I totally agree with you on that, Greg, because I think what we realized also is that there was no perfect framework or perfect solution. that exists today for any investor, and I think what's important was we needed to act now. I think we can't wait for 1, 2, or 3 years for the perfect framework to come about, and that's where GenZero and BCG decided to come together to partner to develop a GenZero climate impact measurement framework. And this framework is not just for us to measure impact, but also how we can actually help improve our investment decision making, right? So I think that's the genesis of how this whole thing started. And what we really discovered also was that, regardless of any investor's mandate or investment strategy, we might all have different ones. I think what we came to was 4 key aspects, right? We had so many lengthy discussions around this, but really these are universal concepts or questions that any investor, regardless of how you think about your investments, can think about climate impact. The first one is on type of impact. The second one is in attribution, so how much impact can you claim, whether it's by your share of investments or your value chain. The third one is in terms of time frame to use. And the fourth one is really an interesting question of how do you think about the trade-offs between volume as well as quality. So we'll dive into some of these points in the next few slides. So the first one on type of impacts, I think an example would be if, say, you've invested in 2 different type of companies. The first one in, say, a forestry project that's planting trees in Africa, and the second one being a carbon exchange that actually facilitates the trade of carbon credits. Now, the question that we have is 1 ton of that climate impact that's created by these 2 different opportunities the same? And here we discovered actually that there's 3 distinct type of impacts, right? Direct climate impact is when companies with products or services directly remove or reduce carbon from the atmosphere, like the forestry project when the trees are actually absorbing carbon from the atmosphere. Indirect climate impact is when the company's products or services are enabling or facilitating, similar to how in the carbon exchange world in terms of trading, carbon emissions reductions or carbon credits to the market. The third climate impact is transformational climate impact, where you could be looking at very early stage, breakthrough type of technologies that's helping to really catalyze and scale the market to a next level. And I think what's important here is that all these 3 impacts are critical for us to get towards net zero. Not one of them is more important than the other, but investors should recognize that they're distinct, they're different, and investment strategies may also differ. Some investors may focus a lot more on transformational, for instance, and some more on direct, but that helps us be more intentional in terms of the type of investments we're making and recognizing the type of impact that we're creating.
And I think what I loved about working with GenZero on this is the intentionality about really understanding these impacts, right? It sounds like when you see this up on a slide, and maybe the slide does it a bit of a disservice, it feels really academic, right? Indirect versus direct impacts. But in the end, you have to make a portfolio allocation decision. Look, 5 billion Sing dollars is a lot of money, but it's a drop in the ocean relative to the amount of money that we ultimately need to allocate. And so you need to be really careful about thinking about how you allocate that capital as effectively as possible. And having a common language to say, look, when I make the decision between allocating investments to a deforestation project versus a carbon exchange, how can I really think about the impact that I'm generating so I can understand these impacts both on a portfolio basis, but really on a direct deal-by-deal allocation basis. And I think being able to make progress and have that common language to think about those trade-offs, it's something we take for granted in financial matters, right? We can trade off risk and returns every day. We have business school classes ad infinitum that teach us this. We're still learning how to understand those trade-offs and make them effectively, and I think the real intentionality about that is critical to being able to make progress.
So on this, GenZero's approach is to actually measure and report all 3 different impact types, but we will set targets on direct climate impact. I think that's really also how we can actually incentivize more capital going into where we actually can really measure and calculate the climate impact that we're actually creating. So the second area that we want to talk about is in terms of attribution, right? So say if you invested 20% into a company, how much of impact do you claim? Now, different investors have different approaches to it. Some would take 20% of the total impact that the company is creating, and some would take, all, right? So, help us think through about it, Greg. I mean, I think it sounds a little bit sometimes, straightforward to just take 20% because, you have 20% of the company, but why is this such a tricky topic?
Yeah, sure. Look, this is another one where if you thought about it from the perspective of what the financial returns are, it's easy, right? You look at a cap table, you know what your equity ownership interest is, you might know what the terms are of a debt agreement. It's really easy to figure out what a cash waterfall is. I know I can teach it to my students at LSE, so I'm sure we can all figure it out in practice. Right? But there's not an agreed upon standard for how you actually do that for impact. And you can see why pretty quickly, right? So imagine you are an angel investor who is the first person who gets a new idea off the ground. You might have a very reasonable claim 10 years into that investment to say, look, we might be a small slice of the overall equity ownership here, but we may have had a transformative effect on helping this business scale up. Or we may have contributed lots of what's called non-investor impact, the kind of things we do to open doors, to upskill the underlying business, to make things possible that maybe capital who's in there just as a purely financial investor, who has a large share of the cap table, may not have had. And so it's a real open question of how you actually want to allocate impact. And again, that allocation is not just a matter of scorekeeping. It's a matter of really being credible and intentional about understanding how the capital that you invest actually is translating into the progress we all need to make towards global net zero. And I think GenZero took a really intentional approach of really trying to, and a conservative approach to thinking about how you actually want to allocate it. But that's not to say it's going to be the right approach for everybody. And I think that's kind of a key theme that's going to come out throughout everything we talk about.
Yeah, so I think what's important here, we talk a lot about this word transparency. Yep. And I think it's important for investors to recognize and disclose actually the methodologies behind how they're thinking about impact and how they're calculating it, so that we don't end up overstating or having double counted a lot of the impact that we are creating. Yep. And that actually is quite a good segue into the third area on time frame. Greg?
So look, I'm going to sound like a broken record here. This is another one that is entirely obvious of how you do it for financial matters, right? When you own the company, if you're an equity owner, you get the benefits of whatever the dividends or cash flows are from that, from that business as your holder. For impact, it's much harder. And let's make the idea really clear. Imagine you've invested in installing a set of solar panels. You're an investor, you hold the asset for one day, and then you sell that off to somebody else. Do you get credit for the entire life of all the carbon reduction that's generated by the solar panels that were put in place for the one day that you held the investment? Right? It turns out that that's an approach that some people take to the way they actually want to think about impact. On the other side of the spectrum, you might imagine that you're an investor, you install a number of solar panels over some period of time, but they don't start generating energy until after you exit. You're an installer, you're not an operator. Right? But those solar panels are going to generate an impact. They're going to be relative to the counterfactual, the outside option, going to be removing carbon or avoiding carbon in the atmosphere for 25 years. Right? Do you get credit for nothing because all you did was install those panels and someone else is operating them afterwards? And so in the end, as we worked with GenZero to address this, the first realization was that there's no one right answer. Lots of people do it different ways. And the key thing to getting any impact measurement system right is recognizing how it's going to affect the decisions that you make about your capital allocation. And so we spent time working with GenZero to figure out what are the impacts that you want to have and how can we recognize the incentive structure around how investments were being made so that you can allocate your capital to its most effective use, and to do so in a transparent way, because other people might not look at it the same way. But if you can disclose it in a way that's transparent and really open and credible, others can interpret it in a way that can allow them to allocate their capital even more effectively as well.
And you mentioned the word incentives, and I think it's really interesting as well, because I think we also want to create the right incentives for investors. If you report impact only for the holding period, then it also creates a certain type of incentives, like people might not want to divest or exit, right? Because then they'll lose the climate impact that they're supposed to measure. But if you hold it for the entire lifetime impact, then arguably an investor could come in and out very frequently and actually account for the entire impact for the company to perpetuity, for instance. Yep. So I think we're also trying to balance, right, the approach such that we create the right incentives for an investment company as well. So I think the last point is also quite interesting, because we're also having a lot of different trade-offs, right, when we think about volumes, quality. What do you think about this, Greg?
Look, so ultimately, you want to be able to set targets around what your climate impact is going to be. And I think there's a natural inclination to think we all ought to be getting better at this, right? We're investing, we're bending the cost curve downwards, and so any given solution should become more efficient over time. And by efficient, I mean how much carbon is removed or avoided for every dollar that you invest. And although that's going to happen at the level of each individual investment, Right? It's going to be the case that CCUS tomorrow is cheaper than CCUS today. That's going to hold for a number of different technologies. It's also the case that we are optimizers. And we have these MAC curves, and I apologize if folks kind of don't yet know what they are. If not, they're probably kind of the lifeblood of kind of lots of folks here. But what it says is, look, there are a range of things that we can do, initiatives that we can take to actually reduce or avoid carbon. Some of those things actually generate positive cash flow right now. Energy efficiency initiatives. We engage in them and we make money today. Other of those actually cost more. And some of those are quite costly. I think out to kind of CCUS and the like, and sometimes costs at multiple $100s a ton. Right now, we are naturally picking the lowest hanging fruit. We are investing in the types of activities where we can remove carbon from the atmosphere or avoid carbon into the atmosphere as efficiently as possible. But as we do those things, we're going to work our way up to doing more expensive things. That's not a bug, that's a feature, right? We are going to, in order to get to global net zero, we are going to need to do the hard things, but we're doing a lot of the easy things first. What that means for incentive setting is we need to be mindful of the fact that we have these two forces kind of competing against one another. We're getting more efficient at each individual thing, but we're also doing the harder things over time. And that's important as an organization sets its targets and what it wants to achieve, to be mindful that both of these forces are happening at the same time.
So what this means is that given limited amount of capital, if we're going up the MAC curve, we're actually investing in a more expensive technology per ton of CO2. The total amount of climate impact that you could generate given the same amount of capital could actually be lesser as we go along the curve. And that's where we also have to be dynamic, right, in terms of how we set our targets as well over time. Absolutely. So how did we think about the guiding principles for putting it into practice, right, on the framework?
Look, so first it starts with that dynamism, right? I'm not sure if folks can read it. We didn't choose the largest font size for people who are beyond the kind of the fourth row here. But there are really kind of four key themes that we've recognized are absolutely essential for folks making progress here. Just for people who can't read them in the back, it's adaptability, defensibility, simplicity, and explainability. And it starts with adaptability, which is that, look, we are on a shared journey here. I've heard that language multiple times from folks, and I think it's critical to remember that. The tools that we have now are a step in the right direction, but they're just a step. And we are all going to be better at this tomorrow than we are today. And we need to recognize that standards are going to change, targets are going to change, and you need a system that's adaptable to that. But then one that I know that we've talked about, and I'd love to, in the time we have for you to speak to it a bit more, is simplicity is the bedrock of this. Like, I have a PhD in impact measurement and management. That should not be the requirement for people to make progress in that space. It can't be a requirement that you need a PhD in climate science. These tools need to be something that's usable by the people who are actually making the decisions, and it's essential for that because it needs to be embedded in the way we're all thinking about capital allocation. Yeah,
exactly, Greg. You're too smart for all of us, but we need a solution and a practical framework that actually is easy to understand, robust, data-driven, but actually easy to understand and actually applicable and usable across the entire organization. So every investment professional can understand and actually use this for an investment decision-making process.
Yeah, and it's the using it for the investment decision-making process that's absolutely critical, right? This can't just be something that lives in a little, esoteric bubble, or, as I've heard some people say, this can't be Appendix 7 of your investment review committee memo. Right? This needs to be something that's on the front page, that's talked about in the same language that people talk about the commercial returns, because ultimately that's how important this is. And so we need to have something that is not only usable by deal teams, but that can show up in an investment review committee meeting and actually be debated by people, like in the same way that we would debate what we expect for financial returns, deal structure, what the macro environment is. It's a fundamental decision-making tool, and so as a consequence, it needs to be explainable and usable. And then finally, I'll just say, because I know we only have a limited time left, it needs to be defensible. It needs to be defensible to your deal teams, to your management teams, to the IRCs, and it needs to be defensible on the front page of the Straits Times. When you say, look, we made an investment that had a climate impact, you want to be able to say that with a straight face, with transparency, and also to hold yourself accountable for when it doesn't have the impact that you expected. Like, we are all taking risks here because it's so fundamental to start making these investments now to get us to global net zero, and having that accountability and transparency is a critical step for us all making progress here.
So actually, this is the last slide, but this is not the end. It's actually the beginning of a continuous conversation and dialogue that we want to have with everyone. I think when we started on this journey with BCG, we didn't want to have a proprietary climate impact framework that was only used for GenZero. I think we really wanted to actually engage with peers, with actually the community, with industry, so that we actually know how to improve on this. Again, I think there wasn't really a perfect framework or perfect solution that we could just adopt from the shelf. We had to spend a lot of time debating, many hours, on many late night calls, and really looking for what the best standards and frameworks are out there, adapting and tailoring according to GenZero's strategy and mandate, but at the same time having that flexibility so that we can continuously evolve as standards actually develop over time to just keep improving on raising the bar on quality for climate impact.
I think that's a perfect way to end it. Yeah.
So that's all the time we have now. Thank you, everyone, and please engage with us.